Hello and welcome back to another week of the For the Property Investor podcast, because we're here with the weekly news. And of course, the only man that can bring us the news is Nick Bendel. Hello, Nick. Welcome back.
Thank you for having me, Owen. Great to see you again.
Likewise. And and I'm sure you've brought us some great news topics this week, because it seems to never end, this news business, does it?
Yeah, humans keep doing things. And while humans keep doing things, we're going to keep having a podcast.
There you go. But before we get into that, what's news in your week?
Well, I had a very good week last week. I own a business called Hunter and Scribe, which is a copywriting agency that writes content for mortgage brokers throughout Australia. So I like to go to all the mortgage broker conferences, and I flew from cold, wet Sydney last week to Melbourne, which was nice and warm, to attend National Finance Brokers Day and had a really good day.
Fantastic. That sounds exciting. Kind of jealous. I don't get to go on holidays like that.
Well, I'm glad you're jealous. And the location was wonderful. I know you're not really into sport, but it was at the MCG. And if you're a sport lover like me, just walking into
Into
the
sport.
MCG is amazing. Oh, you are?
Yeah. It's just not that funny ping pong game they play at the MCG.
Okay. Well, it just feels good to walk into the MCG. I was actually at another mortgage broking
Yes.
conference late
Well,
last
well,
year
it's
at
the
the
greatest,
MCG.
cricketing, cricket ground in the world. So, it's yes, that's what the MCG means to me.
Hmm. Well, I have been fortunate enough to watch a Boxing Day test there and some other cricket. It is a majestic stadium.
Very good, very good. But yes, you were saying you met some brokers.
Yes, and a few lenders and a few old friends, a few new friends. It was a very good day and quite a productive day as well.
Cool. There you go. Um, and we've been busy as well at Leifield. We've this past week we've been doing a review of all of our smoke alarm compliance
Hmm.
checks. So it's something that needs to be done once a year in every property, to make sure they're compliant with all the state legislations, to make sure that every house is safe if a fire breaks out. Well, in terms of the occupants being saved. So need to have working smoke alarms. And each state has different legislation, so it's just it was a bit of a catch up week to make sure that everything was in place. And we made some improvements to our processes. So it's something that we do on a regular basis, is to review processes, make sure everything so that nothing gets slipped through the cracks.
So you have a process to regularly review your processes.
Of course, if anything gets done more than once, it should have a process.
Okay, very nice. I like that approach.
Yes. So, but Nick, do we have some news this week?
We do. Humans have been doing things since we last spoke, so we do have some news. I've got 3 stories for you today. The first one being stamp duty costs outpace incomes. Today's buyers face stamp duty costs that are up to 3 times heavier relative to income than those of 25 years ago, according to Domain. Domain's research found that in Sydney, the stamp duty on a median price house was equal to 44.5% of income in 2000, but 119.7% in 2024. Melbourne's share grew from 36.5% to 109.3%, and Brisbane's from 19.5% to 66.3%. Overall, stamp duty has grown 2.7 times faster than wages in Sydney, 3 times faster in Melbourne, and 3.4 times faster in Brisbane. Domain said that while property prices have surged since the year 2000, stamp duty thresholds have barely shifted. This bracket creep means buyers of even modest homes are now paying stamp duty rates originally designed for more expensive properties. Owen, are you surprised that stamp duty has increased so much over the past quarter of a century?
No, not at all. It's something that I've been talking about for a while, where we need to reform stamp duty. It's a stupid tax. It's a tax that doesn't really do anything for anyone except for raising revenue for the government, and it serves really no other purpose. So that same money needs to be raised though, because the government needs those funds. So it could be done in a lot smarter ways. It has been the topic has been brought up recently with the federal government's 3-day conclave to review tax reform, and no real result came out of that. Just a lot of what ifs. So it would be interesting to see what can be done with it. Something does need to happen. The brackets, if people don't realize, yeah, the price bracket, there's price brackets where the percentage of stamp duty that is charged increases as you go up, as you increase in price brackets, but that bracket creep um, hasn't been adjusted ever, I believe. So we're forever paying a higher percentage as long as property prices keep on going up. So, there could be at least an adjustment that way in adjusting the brackets, but of course, it's not something that hits the news or is becoming newsworthy in the mainstream media. So politicians don't really get hurt by it. So there you go.
You mentioned a moment ago that stamp duty helps state governments raise revenue, which I guess is a positive. Are there any other positives that come out of stamp duty?
Not really. Yeah, it serves no purpose other than for raising revenue for state governments. It doesn't anything else is a negative. It makes it harder for people to be able to downsize their homes. It makes it harder for people to upsize. Basically, it makes the process of buying and selling, or I should say selling and then buying again, a lot harder and financially. So it's a disincentive for people um, to move homes. So it's almost like they get stuck in their house that they might not like or might not be suitable for them anymore. So they're not really in a position where they can change because of the stamp duty cost. That's one of the major reasons. Yeah.
And am I correct in thinking you believe that stamp duty should be replaced with a land tax?
That's one option. And it doesn't have to be a straight swap. There's many different options, at least maybe a phased approach, reduce the amount of stamp duty and then bring in a land tax portion. And you can and then you can have brackets in there based on the median pricing of a LGA, for example. So the lower price properties in an LGA could have zero or very minimal land tax. Now, whether that's just across owner occupied, and also the LGAs can be rated, have a rating system, which could also adjust the amount of land tax that they could get charged. So, yes, former New South Wales government tried to introduce a form of ongoing land tax, and for new purchases, but it didn't really take off, and it wasn't really in for long enough to take effect. Now, the reason why many state governments resist wanting to do something like this is they're addicted to the stamp duty. They get this lump sum of cash all up front and it funds everything, whereas that transition process would be really difficult. But it would having that ongoing land tax would make it a lot easier for people to be able to buy and sell and change either suburbs for pricing or change the types of property within their own suburb for pricing, which could then lower their commitment for any ongoing land tax. So yeah, there's lots of ways to cut it up and make it fair, so that the people that need a bigger house and have bigger incomes can afford the ongoing tax, and so that people who need a smaller property that might be cheaper in value can afford to downsize without this huge lump sum coming out of the equity once they've sold. So yeah, they're all the pros and cons.
I like it. And we've been speaking about how stamp duty rates have increased much faster than incomes over the past quarter of a century, which leads us nicely into our second story, which is about incomes. Wages rise 0.8% in June quarter, but pace of growth slows. The Australian Bureau of Statistics has reported that wages rose 0.8% in the June quarter, taking annual growth to 3.4%. That was the same yearly pace as in March, but well below the 4.1% recorded a year earlier. The ABS said the moderation reflected fewer large pay increases, with the proportion of wage rises above 4% declining over the past year. Between June 2021 and September 2023, prices, i.e. inflation, grew faster than wages, which meant the average worker suffered a pay cut in inflation-adjusted terms. But since December 2023, annual wages growth has been higher than annual prices growth, which means the average worker has been getting ahead. Owen, in the June quarter, wages growth was 3.4% and inflation was 2.1%. When we put those two numbers together, what do you make of it?
Well, it just shows that we're now everything's starting to slow down, become a lot more normal, and we haven't got these crazy figures of wages growth and inflation both fueling each other, and we can all start to get back to normal business, and because figures like that are just out of control. So. Yes, it's not great.
For the past 7 quarters, annual wages growth has been ahead of annual prices growth. But I'm wondering, do we as a nation deserve this pay rise? The reason I ask is because according to the latest ABS figures, productivity fell 1% in the year to March. So I'm wondering, do we deserve to get paid more to do less?
Yes, well, it's when you look at it broadly like that, it's yeah, it doesn't look great for our economy, does it? But there'll be people say, well, yeah, we've been more productive, we deserve a pay rise, or the cost of goods and services have gone up. So yeah, we need a pay rise to be able to cover these things. But yes, you're right, we do need productivity to match. But I think the average mum and dad out there have been doing it pretty tough the last few years with cost of groceries, rent, electricity, all going up. And not everyone has got a pay rise to match it at the same time. And this is the problem. There's this seesaw effect. It's like prices go through the roof, and people might need to go into credit card or short-term debt to be able to cover that in the short term until they get that pay rise. And so this seesaw effect. So it's like being in the boxing ring, and you're getting punched every couple of months with these rising costs, and then you have to wait to get a pay rise to be able to cover it. So yeah, and then businesses are having the same problem. Their cost of goods are going up. and they're trying to raise prices or do things to cut costs, but then they're having to increase wages to be able to keep their staff. So yeah, it's very difficult for businesses out there to be able to uh, keep staff, keep them happy and focused, and on getting the job done, while everyone is copying these price rises. So it's and that's why we need to calm inflation down, then calm down wages growth so that everyone can focus on the job at hand, which is just getting on with the job. And then we should start to see productivity increase.
Okay, speaking of productivity, if productivity has been going backwards, do you know why businesses have been increasing their wages?
Um, um, uh, Simple supply and demand. It's you want to keep good people, and you want to look after your good people. So when they're hurting, and if people are hurting at home, trying to put food on the table for the kids and keep a roof over their head, then they're not going to be very productive at work.
Mm.
So, and this is the cycle that high inflation starts putting into an economy, where it starts to hit wages, and with wages growth, and then productivity drops because everyone's focused on how do we put food on the table, how do we keep a roof over our head, and the employees are more focused about trying to get a pay rise than trying to be more productive. So it's no fault of theirs. It's just the way of an economy and how it works. So that's why we need to bring inflation down, bring wages growth down, and start increasing productivity, and then we can give real wages growth where it's deserved.
Wondering what we can do to make our podcast more productive. Do we speak faster so we can deliver the same amount of information in less time?
Well, we can try. We can try.
Okay, well, let's move on to our third story. Thank you for your time, Owen. That was really, really interesting. Our third story today is rental market tightens again. The national vacancy rate fell from 1.3% in June to 1.2% in July, according to SQM research, which is about where it's been since the start of 2022. The cities with the highest vacancy rates in July were Melbourne at 1.8%, Sydney at 1.5%, and Canberra at 1.5% as well. The other capitals were all below 1%, Brisbane at 0.9%, Adelaide at 0.8%, Perth at 0.7%, Hobart at 0.6%, and Darwin at 0.5%. SQM Research Managing Director Louis Christopher said rental affordability was deteriorating, particularly in Sydney, Brisbane, and Hobart. Unless we see a meaningful uplift in rental supply, particularly in the inner and middle rings of our major cities, the market will remain challenging for tenants heading into spring, he said. Owen, at a national level and also at a capital city level, vacancy rates are very low. But I'm wondering, what is your property management business, Leifield, which operates in 5 states? What are you seeing on the ground?
Um, it's still fairly healthy. The vacancy issue isn't necessarily getting any worse, but it's not getting better anytime soon. So it's at least we haven't got skyrocketing rents anymore.
Mm.
There are still areas where they're in high demand and rents are increasing. So we're seeing that in definitely in some areas, but there's others where there's some oversupply and it's taking a little longer, especially during winter months in some areas. In some regional areas, it can take longer to rent, but that can be hit and miss as well. So
So you're talking about local markets, which is how we should probably talk about property, because of course it's all a local game. That said, the data we get is for state and national. The national vacancy rate, as we discussed earlier, it's been incredibly low for 3.5 years now. Do you see that changing anytime soon?
not anytime soon. It's as I just said, it's not getting any worse, like it has been, but it's not going to get better anytime soon. Not until we get a lot more supply in the market, which is apparently coming. And yes, we're getting new builds on as managements as well, which is good to see, but a lot less than we used to see in, say, 10 years ago. So yes, a lot more needs to come on, so we can take up that extra demand.
Now, I'd like you to get a little philosophical for me. When the vacancy rate is low, landlords are happy. When the vacancy rate is high, tenants are happy. So, as a society, where do you think we want the vacancy rate to sit as a long-term average?
Um, it's probably around that 2 to 2.5% mark, which should cater for, natural vacancy as people are moving, and properties might be empty for a week or two, at most, and it's just getting to that point, which is yes, it's we'll see from there that prices will start to level out. Once you start getting over 3%, then it's getting a bit too much, and it swings the other way. And it's so we need to see a nice balanced flat market, and but of course that's in a perfect world,
Mm.
and it'll be like that for a little while, and then it'll swing the other way, and then it'll have to swing back. So yes, it's not something that we can totally control, but yes, that's the ideal world.
Well, that's also a great way to wrap up the podcast. Owen, as always, thank you for your time.
Thank you, Nick, and looking forward to seeing you again next week with the weekly news.